Welcome back to Chapter 8 in Intermediate Accounting. In this chapter, we're going to cover some kind of one-off inventory things. This chapter is all about inventory measurement. So let's look at some real-world stuff when it comes to inventory. So based on the SEC filings and accounting surveys, roughly 60 to 70% of U.S. public companies use FIFO, first in, first out. 55% of the companies in the S&P 500 do. Another 20 to 30% use weighted average, and less than 15% use LIFO, mostly in specific sectors like oil, gas, and manufacturing. So if you didn't see the last video where we talked about all of these different methods and how to account for those, make sure you check out the third video for this chapter. But just thought it was interesting to see what companies typically use. So this little kid wanted to hear what we had to say. Now, I also want to tell you that LIFO is not permitted under IFRS, under the International Financial Reporting Standards. That is only allowed with GAAP, not with IFRS. Examples of public companies that primarily use FIFO are Apple, Coca-Cola, Procter & Gamble, and Nike. So lots of companies that are using using FIFO, and even though they have the option to use weighted average or LIFO. So what about the physical flow versus the accounting method? So the thing is, and I mentioned this a little bit in the last video, is just because a physical flow of goods, the actual movement of goods is one way, it doesn't have to be the same for accounting. This is important for managing perishables and obsolescence. So the physical flow of inventory, we talked about in the last video, if you're selling milk, you want to get rid of that milk as soon as you can, right? You want to get rid of the first ones you bought first because they're expiring. But that doesn't mean that you have to account for it that way. So the costing method that you choose is not necessarily tied to how the actual inventory moves. So that's important to understand. I was talking to somebody one time who worked at a company that they did have something, it wasn't as perishable as as milk, but it was something that they knew over time it was still, and they knew it was going to rust over time. And so they still tried to push the first ones that they got. They tried to push those out first. And I asked them, what's your accounting method? And they said, well, I assume it's FIFO because that's how our physical flow works. And I said, well, it's not necessarily. It quite likely is, but it's not necessarily the same as the physical flow. So the type of inventory method that is chosen is a lot of times for financial reporting strategies or for tax strategies. And those actually can be different a lot of the times. So key points to include: companies aren't required to match the physical flow with the accounting flow. FIFO is often used because it matches the actual flow of inventory. So even though you don't have to, a lot of companies, the majority of companies do choose FIFO, and a lot of times that's because it does match the flow, and they say, why not just go with it that way? LIFO can be used for tax advantages because in a time of inflation, which is typically what we're experiencing to some degree, we are going to see higher costs of goods sold, which results in lower income and lower taxes. So it doesn't have to be how the inventory flows. Even if they're using FIFO with their inventory, they're allowed to use LIFO for their financial statements and for their taxes. But a lot of companies, as I said, do choose the same accounting method as their physical flow just for simplicity. So then we have the LIFO conformity rule. So this is important for income tax purposes. As I just said, a lot of times companies choose to use LIFO. But if a company uses LIFO to measure taxable income, it also must use LIFO for external financial reporting. So they can't use it just for tax purposes and then use something different for their financial reporting. There are some things with other types of inventory or with depreciation methods that we're allowed to use one type for tax purposes and one type for financial reporting, but there is a rule that we're not allowed to do that with LIFO inventory method. So we're kind of blowing through these really fast here. Inventory balance under FIFO, or average cost used to maintain internal records, If you're using those for internal records, but then you're using LIFO for external reporting, you're going to do something called LIFO reserves. Now, again, this is not where we're using LIFO for tax purposes and something else for financial reporting. This is where internally, well, I pointed at myself, not internally like in your body, but internally in your company, you are choosing to use weighted average or FIFO. But external reporting for all of the users of the financial statements at a public company, you're choosing to use LIFO. If that's the case, you're going to have something called LIFO reserves for the difference. So you take the inventory balance under FIFO or the average cost method, and then you subtract out the inventory balance under LIFO so that you can get the external numbers. And if you use it for financial reporting externally, you can also use it for tax purposes at that point. So the difference is going to result in a contra account called LIFO reserves. So you're going to have your inventory and you're going to have LIFO reserves there. So motives for an internal method. So maybe, okay, why would you want to use LIFO for external, but then internally you're using FIFO or the weighted average method? So record keeping costs for LIFO are high. And we're going to look at a lot of different things that have to do with LIFO as we finish this chapter up in this video and the next. Bonuses and profit sharing plans are often calculated based on net income with a method other than LIFO. So think about this. If you're a manager or an executive and you are going to get a bonus based on how much net income there is, you could say, I want to use FIFO because that's going to result in a higher net income in an inflationary time. And that's what my bonus is going to be based on. Not that one manager necessarily gets to decide, but if the company chooses, yes, we can do it that way, then that may be why they're using a different inventory for internal reporting. FIFO and the average cost information may be used for pricing decisions as well. So there are several reasons that they could choose different methods to use internally, to use externally, and maybe even different for tax purposes if it's not just LIFO. So you learn a lot more about all of that and the internal reasons of the way that you keep inventory in managerial and cost accounting. So hopefully you can kind of relate that back to that. But we won't jump into that now. We have enough to cover in this chapter. So let's look at an example of LIFO reserves. So Galactic Gadgets began operations in 2025. The company maintains its internal inventory records using FIFO, but reports the ending inventory and cost of goods sold using LIFO. Internal records reveal the following for their first 3 years of operations. So for under FIFO, they show the ending inventory versus the cost of goods sold. So we see that we've got for FIFO, ending inventory 130, 170, 185. Now let's jump over and look at the LIFO numbers. So for LIFO for 2025, it was 120,000. So FIFO, as we just saw on the last slide, was 130, but under LIFO, our ending inventory was only 120. So the difference between the two is 10,000. So they need to show this $10,000 difference. We're going to increase cost of goods sold for that because we have a lower ending inventory. So that means more in cost of goods sold that we sent out of inventory. And then we credit the LIFO reserve contra account for that 10,000. So we're trying to keep the LIFO reserve as the difference between FIFO and LIFO. So then at the end of 2026, we've got a LIFO reserve balance of a credit of 10,000. Remember, maybe you want to jot that down on a piece of paper. You've got your T account LIFO reserve credit of 10,000. Then at the end of 2026, we already saw that FIFO had 170, but under LIFO, they're showing 140,000. So the difference here is 30,000. But we already have 10,000 in the LIFO reserve account. So we take the 30,000 that we need to show as a total reserve, subtract out the 10 that's already there, and then we just need to credit LIFO reserve for the 20,000. And then that's reflected in cost of goods sold. So right now, the balance, if you're keeping track of it, in the LIFO reserve is a credit of $30,000, because this is not a temporary account. This is a balance sheet account that's permanent, and it just builds on itself. So because of the 2025 entry and the 2026 entry, we have a total of a $30,000 LIFO reserve, which takes our $170,000 in FIFO down to $140,000 for LIFO. So now for 2027, we are showing our FIFO balance at $185, but under LIFO, it's only $160. So the difference now is $25,000. Well, remember, if we had taken the prior 2 years from 2025, the $10,000, and 2026, the $20,000, we have a credit of $30,000 in LIFO reserve. But the difference between FIFO and LIFO are now only $25,000. So we need to decrease the LIFO reserve by $5,000 to bring it to a credit balance of $25,000. So in order to do that, we're going to debit LIFO reserve, and then we credit cost of goods sold. So this will definitely make it easier if you keep a T account as you go along. So hopefully that all made sense. All right, just a little more with LIFO reserves. So here we're looking at the way that they reported FIFO ending inventory, subtract out the LIFO reserve, and that's the total balance in LIFO reserve each year if you got that T account. Then that brings us to the ending inventory under LIFO, which matches up well. And then that shows what our cost of goods sold actually ended up being under LIFO. So we had our cost of goods sold with FIFO, and basically here we just added it a little bit. We added 10,000 more in 2025, we added 20,000 more in 2026, and then we actually took 5,000 out in 2027. So if you follow along with all three of those slides, it should show you the whole process of getting our internal reporting for FIFO to our external reporting for LIFO. So then we also have LIFO liquidation. So we've actually already looked at this, but let me just go ahead and explain what it was that we saw in the last video. So it occurs when a company is using last in, first out and sells more inventory than it purchases. The older inventory layers from previous periods are liquidated or used up. The cost of goods sold is based on older, usually lower cost in inventory. So we did this with the LIFO method. We said, okay, we sold, 2,000 units, and we're going to go to the most recent purchase. And if that didn't cover all of it, then we're going to have to go to an even older purchase, which is going to be liquidating another layer. So this is exactly what we did with LIFO. This is just kind of explaining what it's called, LIFO liquidation. And you got to put something fun in there, right? All right. So just-in-time inventory. You may have heard of this before, but some companies use this. It's an inventory system where materials and products are delivered only as needed in the production process. So the goal here is to minimize inventory holding costs and reduce waste. So inventory is such a tricky thing, because as a company, you don't want to have too much money tied up into inventory, because that's a lot of your cash. And if it's just sitting there for months or years, then you've tied it up into an asset that's not making you any money. If it's just sitting there and not selling. So just in time is saying, no, let's not keep a bunch of inventory on hand. Let's just get what we need in the moment, basically. Kind of like if you go to an auto body shop and you're like, yeah, my car needs this part. And they say, okay, well, it's going to take 2 weeks to get it. You're like, are you kidding me? Well, they don't want to have all the different car parts for all the different cars sitting in a warehouse somewhere, because that ties up money for them. So instead, they wait until they literally have to have it. So that's a really extreme example, but it reduces the actual storage cost, so they don't even need a warehouse for it, improves their cash flow. It's not tied up in inventory that's sitting there for months and months, and increases efficiency and responsiveness. So, I think of a company like Amazon. It would be unbelievably tricky to get the right balance for Amazon, because they want to be able to ship it to you in 2 days. But at the same time, they don't want to tie up a ridiculous amount of money in their inventory when they have like tens of thousands, if not hundreds of thousands, if not millions of products. So that would be so tricky. I would not want to be in charge of the inventory um, flow with Amazon, because they really have to make sure they are getting it right in order to stay in business. And I'd read an article that, Kmart used to be much bigger than Walmart, but Kmart had some issues with inventory and keeping up with it the right way. And Walmart was trying to adopt at least a partial just in time inventory method, and they were more successful and kind of kicked Kmart out of the competition because they were better at managing their inventory. So it's really important. It can make or break a company for sure. Last slide we'll look at in this video, and then there'll be one more video for this chapter before you move on to the next one. You're getting close to the end of Intermediate 1, so that's exciting, right? So these are inventory assessing ratios. We have our gross profit ratio. We really want to know how much money we're making, and our net income tells us that. But our gross profit ratio tells us how much money are we making just taking sales and cost of goods sold into consideration. So we take our gross profit, which is our net sales minus cost of goods sold. So our gross profit divided by net sales, and that gives us a percentage of how much are we then left over with to be able to cover other operating expenses, and then enough to make a profit, some net income. So we want our gross profit ratio to be high. Then we have our inventory turnover ratio. We just take our cost of goods sold divided by our average inventory. And to get the average inventory, just take the beginning of the year inventory plus the ending of the year inventory and divide them by 2. So you don't have to do it like every month or anything like that. It's just the beginning of the year and end of the year. What this tells us is how often are we selling out of most of our inventory. So if you're selling apples, you're probably going to hope that your inventory ratio is 52, right? You want to sell out every week and get fresh new apples. If you're selling computers, it may be more like, I don't know, 10, 12. I don't know. How often are you selling all of your computers? So this helps to see how long are you tying your money up into that inventory. You don't want it to be 2 necessarily, because that means you are holding on to your inventory for 6 months. In that case, you only turn over your inventory twice in a year. So that probably wouldn't be ideal, but perhaps some industries it makes sense. So that will also help to see how well am I using my resources to make a return.